Okay, welcome to this part 3 of Opportunity Zones Meetup. Tonight's program is on the topic of matching investors with Opportunity Zone projects. In this part of tonight's program, we're going to shift the structure a little bit, and this is going to be more like an open forum discussion in which each of you gets an opportunity to participate in the discussion. And I'm going to kick it off with a couple techniques and tools that I'm using in order to do matching on investments in general, which is also applicable to opportunity zones. And then I would like for any of you who would like to share, what you're doing or any challenges you're facing. I'd like to get all these, out in the open, and we can dialogue on this during this part 3 and see if there's, we get to a better understanding of what might be some of the things that are causing this apparent mismatch or higher level of mismatch than ordinary investors. So to start this off, one of the things I like to use is what I call stakeholder analysis. This is a tool that I commonly use on any project I'm involved in for both strategic planning as well as funding. And what I do, this is a chart which you'll get a copy of in the slide deck. It shows the sugar beet district across the top. It's asking who cares about the success of this particular project. And to do this analysis best is you don't put investors on this chart at all until you're done with everybody else. And so the question is, who would benefit if this project goes forward at any stage along the process? So you'll have contractors out here who are going, yes, if this project goes forward, I have an opportunity to build that building or to put in that sewer line. And if I get that contract, that would be good for me. So I'm in favor of this project going forward. I will talk to different people who may be tenants in the project. And in a large enough project, the tenants may be someone where they go, this is the place I want my business to be. This is like the perfect location for my business, or the right style, the right modality for it. And so I want to be involved in this project. I want it to succeed so I have a place to put my business, which is true for a business who's relocating into an opportunity zone. We may find in this particular project that we may have an office park, so to speak, with a bunch of cubicles where everybody's hanging their shingle just so they have their location within an opportunity zone and they're meeting the requirements for their home base or headquarters. We get into economic development. This particular property right now is generating almost no tax revenue to anybody because it's an undeveloped field. But upon full build out and approximately $240 million of improvements to this in new buildings and so forth, it's going to become a major property tax beneficiary currently to the county, Larimer County. And so the county is obviously going to be interested in us completing this because this is going to generate a lot of new revenue for them from that standpoint. We're also talking about creating all kinds of jobs. Jobs create more tax base for both city, county, state. We get into other types of projects that we're doing on site, which may also contribute to the local economy or create local economic activity. Then we come over here and we have social causes. So we're talking about a live, work, play design, and there are a number of social causes out there that are environmentally oriented. They're saying, so what are you doing? Well, we're going to go to net zero. We're going to go power, waste, water. We're going to try to have zero impact. We're going to try not to be dependent upon the municipal utility. So we kind of are like a cruise ship with our own capability all in one spot. And what that means is that we're going to be friendlier to the environment overall. And anybody who is a social cause activist for improving the environment, who wants to see large-scale demonstrations of how to be kinder to the environment, is going to be asking about this project and may become a supporter of what we're trying to do. And then we go to the far right over here, and we're talking about the media. We actually become a source of stories for the media. The media has to scramble every day to come up with a really cool story. We could be a whole collection of stories over the development of this, going through the construction of the net zero issues, the live, work, play design, each tenant who comes on board. Those who've seen Mike Baselli with the Catalyst, he's putting out an announcement every couple of weeks. We just recruited in a new tenant to our project. It's a news story, and he always gets his story told. So all these different things, when you're doing the analysis, you map it out. And this is a free piece of software that I use called CPACE, which is not the same as Colorado PACE, just for clarification. But it allows you to visually kind of put everybody in a bucket, figure out that this group has a lot of common interests, but even there you may break it down into sub-interests. And by the time you get done, you suddenly realize there's a whole bunch of people who will benefit if you succeed. You're not the Lone Ranger, you're not out there by yourself, unless that's the way you style your business and you conduct yourself. If you're doing this from a community orientation and you're thinking about all the different people who will benefit from this, this is all good. I know, like Mike has an interest in new forms of housing, particularly workforce housing, and I'm working with Tom on some new equity share models for workforce housing, because wherever you create the jobs, almost invariably there's a shortage of appropriate housing that is low enough in cost that you can actually move somebody in. And in the urban areas here in Colorado, they're almost all so high in price that there's no way to get there from here using standard mortgage financing approaches. So we're looking at different ways of splitting this into 2 or 3 parts, with Opportunity Zone funds carrying part of the weight and allowing this housing to take place, to move people from renters to owners so that there is a longer term play, and automatically anyone interested in housing is interested in what we're doing and hoping we succeed. Because if we succeed, we're going to solve a major problem for them. And this has a 40-unit residential component in the project. And as we talked about earlier, we can break this into pieces. We can have one part of this project just the residential workforce housing. We can have another one for the brewery, one for the distillery, one for the hops greenhouse. All these things can be individually funded, all as Opportunity Zone projects. So this is something that I recommend everybody do, because after you identify everybody, then you go through the list and you ask yourself, who cares more? Who cares most? Because the people who care the most are the ones most likely to help. And if they can't write a check, they're going to go find somebody who can write the check, because it's in their self-interest to do so. After you've done all this analysis, then you can throw the investors on the table. The investors, if they're coming institutionally, are looking at this primarily from ROI, and that's their sole or only criteria. But if we get into impact investing, social cause investing, we have all the impact investors as another class. And we're looking at doing a local food project down in Pueblo where we may have a capital stack with 3 types of funds. We've got the Opportunity Zone across the top, which is an ROI focused. We're going to have social cause in the middle, which could include foundational money or donor advised funds or other types of social causes. And then we may have a crowd-funded community fund for local employers, local citizens who are going to benefit from the existence of an improved food system down there. And their primary benefit is not the investment, but from the fact they have access to fresh food year-round. And to that extent, they don't need a high price of money, because their primary benefit is over here rather in the money bucket. So doing this kind of analysis is one of the things I do, and I wanted to share that with you. Many of you are aware, the state of Colorado has on their website created a matchmaking site. If you are a project or a fund, you can go there and list your project in the public carefully, because if it's a sale of securities, there are still issues that have to be, you have to color inside the lines. But this is something that is so radical for a state to create this kind of matchmaking capability. When I heard about it, I wasn't certain I heard it right, but this is a great tool, and the state of Colorado has been great on Opportunity Zones, both in getting out there and trying to define zones where good things can happen, and then in publicizing this and encouraging communities and actually providing grants to communities to put together local plans to take advantage of this. So this is another tool that's available. Another one that you may be familiar with is AngelList. If you're an accredited investor, an angel investor, this is a national platform where deals can be listed, and it's limited to people of wealth who meet the definition of accredited investor, but there are tons of deals on this particular site. It's a keyword searchable type of site, so if you put in some of the things you're looking for, you may find something, but it's not a very precise tool because of its breadth and scope and everything else, but it's something that's out there. Another one that I have tried to use, and I'm not going to be bragging about this one, but there are a number of private sites like Signal who are also trying to be intermediaries or matchmakers, and they make their fees in different fashions. They're not allowed to charge a commission, which would be tantamount to being a broker-dealer, but they are either selling advertising or subscription fees or listing fees and things of that nature. So it's kind of like a Craigslist. And again, as long as it's a generic thing, it's going to be harder to find something. If you have something limited to opportunity zones or opportunity zones in Denver or opportunity zones in Denver that advance environmental causes, it's going to be more likely that you're going to get a quick, easier match than if you are a generic, open, anything works kind of a deal. So with that, I'd like to open up the floor to discussion, any challenges, anything you're doing, anything that would work that might make it easier to match up with someone.
Sure. I have some thoughts.
Okay.
I think you really hit a lot of nails on the head. We've kind of taken this apart and looked at who's come to us, and by and large, either through their tax attorney or their CPA or their private wealth manager, they come after they've understood what a QOZ is, after it's blessed by the CPA, and so going to CPAs, let them know what you're doing. I think it's a real good avenue because it makes, if they trust you and like you, they're not going to get compensated, but they don't want to lose. They don't want to put their clients in a bad deal.
No, I talked with a national CPA firm last week. They make their money by helping put together cash flow projections and analysis of projects, helping with due diligence. That's how they make their money, by charging fees for those kinds of activities. If they have a client looking for money and they know about a money source, they do a free introduction. There's no broker-dealer involved. There's no commission involved. This is basically an accent or amplifier to their underlying services. It's good for them to have the matches occur because if the deal goes down, they get more work. So this is why they show up. Service providers are almost every single stakeholder chart I've ever done because someone is going to get more work on one side of the transaction or the other. And so, yeah, using CPAs is a good thing. What you'll find is typically those people are very, very conservative, and they may not have the ability to truly evaluate the deal. So the more your deal is non-standard or not anything they've seen before, it's going to be harder to communicate to them, and you may be translating continuously, trying to make it say, well, you guys were involved in this project. This is just like that except for this. So you're trying to give them something to hang a hook on, that this is what they're working on, because they're not necessarily trained analysis. And even investment advisors tend to weigh to the conservative side because they don't want their clients losing money on a bad deal and having no more money to advise on. So it's an interesting thing, and a lot of times the investor is so distanced from this whole thing, you may never see him. It's like, here comes the check after you talk to 3 or 4 people, but you don't even know who the true investor is, or you're not talking to him directly. And in that case, it makes it really hard to communicate because the advisor does want to like you. If you come in and they don't like you, you're out the door. But as I mentioned, your project, you're doing intentional siloing of, this is an interest that matches up with this group. Because the oil and gas guys love oil and gas deals, entertainment love entertainment, and if you come to them and go, we're doing real estate, and don't tell them it has entertainment on it, you may not even get a second conversation. Other things. Yes, Mike.
Karl, could you cover a little bit more on the callable fund aspect? Because I know you've done a lot of work on, putting together Oz funds. You've done some really good documentation on the sugar beet project that you're working on. A couple years ago, I went down to Miami and attended a family office conference. And I was in a room with 200 wealth managers for some of the largest family offices in the country. It was actually an amazing event. but I'm looking at that callable fund strategy to determine whether or not there's a way to actually approach, the family offices in the marketplace to create this callable fund. I want to learn a little bit more about that.
So one of the challenges in Opportunity Zone funds is the fact that if the money comes into the fund, it has to be deployed within a period of time, within 6 months, into a business or a property. And so people have to be working to make sure that the project's ready to receive money at the same time the fund's ready to receive money, because as it comes into the fund, you want it to move gracefully within 6 months into that property or business. If you're doing a what they call multiple asset fund that's doing different things, all these projects are on their own time clock. And it's very difficult to sync up, which is why we're seeing single-purpose dedicated funds being the most prevalent use of opportunities, because those are doable. The other ones are possible, they're complex, and getting into them and out of them has more complexity to the point that some people are struggling to make it happen. And so they have to start making all their projects look alike, so if they're doing 10 residences, they're all the same type of residence, or they're in the same area. Trying to do things that are scattered across a geographic area, or a multifamily here and an equity here, is probably not ever going to work well. So because of this difficulty in the money into the fund and out, what some are doing now is they're doing what they're calling callable commitments. So they're not actually taking the cash, they'll sign an investment agreement without moving the money into the fund, and it says at moment's notice, we're going to call you. As soon as this project's ready to go, we're going to call you. When you call, the money may not be there, because there's no way you can force them to hold it in that agreement for fear that they're going to come up against their deadline, lose their tax incentives, and so forth. So when you call, there may be no one home. And so you typically have to oversell or get an overcommitment, but this way you don't get money trapped in a fund and face a potential backlash in the form of including liability to the fund because you didn't deploy your money as you contracted to do within your agreement.
Well, at the point that call's made to the investor, are they in a situation where they actually have to liquidate an asset in order to get that capital gains, and there's a time lag or duration for that?
The draft documents that we distributed at one of the earlier sessions here, we gave them a 10-day call.
Got it. Okay.
We told them it needed to be in cash or, near cash. I mean, it could be in stock on Wall Street,
right,
that they could sell the stock and roll it, but they can't have it in real estate or anything else that's got a long closing period. It's got to be cash, because when they call, it's all got to go down.
So really, they're within that 180-day period.
Yes.
And when they sign that agreement, now that deals hopefully will come in within that 180 time
Right.
window.
And if they're, in all likelihood, they're making multiple hedges against other things or looking at other projects so that they do know where that money's going to go. If this is their preference, great. If it doesn't get the call, it's going to go to number 2 or number 3. It's going to cascade down.
Is that what Fundrise is doing, the real estate funding platform?
I don't know. I haven't studied.
You know those guys? Yeah, I've been looking at their model. I just was kind of curious, how many investors would you need to put together callable commitments like that to really have a serious platform that people would look at? 10, 20, 30, 100?
It depends upon the amount of money you need and the size of money the investors have.
Gotcha.
So if you're doing crowdfunding at $100 a pop, you're talking in the thousands and thousands and thousands of people.
Yeah.
If you are working with a low-level angel, $25,000 to $50,000, I've got a group that's looking for $1.7 million right now, and they ask me that question, how many investors are you going to need?
Yeah.
And I'm like, 1. If it's a good day. If not, we're probably looking at 50 to 100,000 per person.
Got
you
it.
do the math, and you know how many people you got to have.
Okay.
If you're out shopping and you're holding commitments, you may need to have twice that many or 3 times that many to make sure the money's still there when you get there. If you're struggling to put your project together, there's no certainty the money's going to be there when the call goes out.
Very good, thanks.
Yes.
As Economic Development Director for Morgan County, I'm receiving a lot of unsolicited calls from investors looking for investments. And what is hot on their, or top on their list right now, multifamily housing. And
Because it's guaranteed profit, right?
Everybody wants that.
I'm working with one person wants to build a 12-unit apartment. I'm working with another person, they have a $1.5 billion fund. So it's that that extreme.
Excuse me?
And, then the other point that you made that I'd like to just touch on, marginal projects that become doable under the Opportunity Zone. As you know, I'm working on a 200-unit apartment house complex, have been doing so for 2.5 years. We had an $8.5 million gap fund that needed to be met. $4 million of it had been taken up by in-kind contributions from the city of Fort Morgan, so we had $4.5 million left. And a year and a half ago, I didn't know how I was going to get that money. I talked to corporations. They weren't going to open up, that were in Fort Morgan, they weren't going to open up their wallets, even though housing was their #1 concern. The Opportunity Zone came along, and that $4.5 million gap funding need has been pre-sold by a private equity group that I'm working with. So, that's the difference between, having a project that is in a location that is prime, like a Tier 1 city, and having a project like I had in a Tier 3 city where people were not going to come my way unless there were added incentives, and the Opportunity Zone has provided that.
So Greg, you're now a Tier 3 city?
Yes. by most considerations.
Congratulations.
Yes.
This is one of the things that was, we did a lot of in-depth analysis late last year on where is Opportunity Zone going to have the most impact. From an investor standpoint, it isn't that there's any more money available unless the incentives are good enough to cause people who are sitting on passive investments, and this is the way it was designed. There's people who have stock on Wall Street that's been sitting there 5, 10, 15, 20 years, and it's essentially just sitting there not really working. The money's there, so the incentive was to say, hey, sell that, okay, which is going to cause a tax gain recognition, but the incentive is if you move it over here into this distressed community to Brush, Fort Morgan, we're going to waive some of those taxes, and then if you make more money, we're going to waive all those taxes. So there's enough compelling reason to take action and to take a passive asset or a non-working asset and make it a more workable asset doing real good economic gain. But that's from the investor standpoint. They're just going to move one investment to another. From the people who are trying to raise money, the bad deals are still never going to get funded. Okay, but there are those that are just below the margin where the investment group may say we need a 10% ROI and this is only going to generate 8. Okay, and they go, so I can't do it. Now with the tax incentives, they go net, 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 this is now worth maybe 11, 12, 13% net, net ROI. So they can now see you. They go, hey, that fits my criteria. And it's interesting from a deal standard. Just moving the bar down 1 or 2 points is not a linear motion, it's a geometric progression. Instead of 10 more deals, there's like 10,000 more deals who are all in the 8% range, who were never visible before, but now they're meeting these criteria. And I think, again, that's something that's contributing to the problem is that once there's 10,000 deals, it's harder to pick one. And there's more to choose from. And you're all competing with each other. So by definition, it's going to be hard to match, just because of volume change. And I think that's, again, why databases and other tools are probably necessary to either automate it or simplify it or do something that is beyond the skill of the average person, including an advisor or CPA, who may not be skilled in doing deal assessment or finding deals. Anyone else got something to share or suggest?
I think intermediaries for 1031 exchanges are great targets because they don't have to deal with the like-kind assessment, and they can put their money in there and park it even if they don't leave it for 10 years, and it's a parking space.
Yeah, we found a lot of people rolling out of 1031s into opportunity zones for a variety of reasons. One is the time frame to get money to a 1031 exchange is actually shorter than doing an opportunity zone, so you've got more flexibility in matching up with a project. We saw a lot of farmers who had reached a point where they want to start liquidating part of their farmland. If they did a 1031, they have no cash. Where with a opportunity zone, they can roll over the capital gain and keep the cash of their underlying basis. So they have some working money for either their health or their retirement or something else. And the intermediaries who are already working in this area, yeah, they're seeing these kinds of properties. They already understand tax impacts, so they are closer to having an immediate pickup and understanding how opportunity zones work. And there are a number of people out there who serve as intermediaries or escrow agents or support the 1031 marketplace. So it's another place to go hunting, both for projects and for funding. Any other suggestions? Okay, we're going to call this for part 3. Welcome to the final part 4 of tonight's program on Opportunity Zone Meetups. We have been discussing different ways of matching investment dollars with Opportunity Zone projects. In this last step, we're going to talk about what else we might do, what hasn't been done, things that may be on the drawing board for consideration that would make it easier, quicker, faster to get the right funding with the right project, so we can all remain working on the project instead of spending our time trying to raise funding. So towards this, there are some options we have here. One is do nothing. I always try to remind people that your biggest competitor is not the person down the street. It's just nothing ever happens. Right now, I think that we have a large enough need that we can come up with some better solutions, and we'll try to figure out what those are. One may be to try to improve upon something that already exists. So we might talk to AngelList or some of these other systems or platforms and see if they'll add a data file or a data field that would be appropriate for opportunity zones, or even breaking it down, maybe going back to the state and saying, yes, we understand you can't put financial information in here, but if you would add the following categories, this would make life better for everybody. So I'm going to talk to Janet Persky about that and see what she may be able to do at the state site. And the other is maybe do something from scratch, meaning come up with something new that doesn't exist yet, and do this as a particular tool specifically to help us with opportunity zones or for one of their stakeholders who have an interest in this. So I'm going to bring to your attention one of the options I've been looking at for both hemp projects I'm working on right now and for opportunity zones is to buy something that's off the shelf that has a matching function built into the software already.